Now, with the budget looming, we're joined by Michael Knox, the Chief Economist from RBS Morgans, for more on what we should expect tomorrow night. Welcome, Michael.
Good evening, Peter.
Now, mate, the budget, you're an economist, you must be excited.
Well, about 3 weeks ago, the IMF released their latest outlook, World Economic Outlook, and together with that, a whole bunch of data which included forecasts for Australia and other economies. So we wrote a piece on where we thought the things like total spending and the budget deficit might go based on the information given us by the IMF, which is, hey, that's a great place to start. And really interestingly, Olivier Blanchard and his team came up with a 2013 figure for the Australian budget deficit of $17.5 billion, which 3 weeks later looks, pretty close to the mark, and that's 1.13% of GDP. But they pretty much said that, and I'm sorry that other people might be listening to us, that wasn't caused by low revenue, but it was caused by high spending. And they noted that back in 2007, we were spending, or the government was spending 34.2% of GDP. That blew out to 37.5% in 2009, held around 36.5% to 36.6% up until this year, where it's fallen to 35.6% of GDP. So even with that reduction in spending this year, spending as a percentage of GDP is still 1.4% higher than it was in 2007. The budget deficit is only 1.1% of GDP. If you were spending only as much as we were in 2007, we'd have a surplus this year. So the real issue is not revenue, the real issue is spending. The IMF says that it's not until 2015 that we get our spending as a percentage of GDP back in touch with where it was in 2007. Then they say it'll be 34.4% of GDP, which is 0.2% higher than 2007. And around about then, they say we get a small budget surplus. So again, it's about spending, it's not about revenue.
Well, yeah, it's funny you should say that. The argument you're putting forward, the government's saying it's the Australian dollar, it's the fall in commodity prices, it's the weakness of China. In a sense, it's foreigners' faults. But you're saying, no, this is our spending. We have to get our spending in order if we want a surplus.
Yeah, we have to have more control of spending. But it is interesting that even with the small deficit we've got, a 1.13% of GDP, this is a very significant fiscal contraction. In 2 years, the deficit has decreased, or will have decreased by 3.1% of GDP. And if you use the normal fiscal multipliers, I can think of occasions in which we would use that sort of pliers, but the fiscal multipliers, which is in Australia is about 0.74, well, that knocks about 2.3% of GDP. And what normally needs to happen is the central bank needs to cut rates by at least that amount or greater in order to balance the reduction in fiscal stimulus. And we've had 2% of rate cuts. So we're probably going to need more to counterbalance the fiscal tightening we're getting because of the reduction in deficit. But you wanted to hear that anyway.
I did, because I always like to hear your very accurate portrayal of our reality. But let's talk our future reality. What do you think the Aussie economy will grow by in the next financial year? Because let's face it, Treasury thought we're going to grow at 3.25%. I know the Treasury's been making a big song and dance about the fact that no one could have tipped that we wouldn't grow by the amount that Treasury predicted. Well, I tell you what, on this show, I didn't believe the 3.25% number. What do you reckon we will grow at next year?
Well, firstly, it is remarkable that you have a fiscal contraction and you have a slowdown in growth. I think everybody who's learned Keynesian economics knows that that's very likely to happen. But I think it's wonderful that leading bureaucrats can say this was totally unforeseeable. Okay, on to the actual question that you asked me. We've got a growth model in which we lag China, which was soft last year, and still just coming off the low. We've got a US economy, which is also in our model, which is growing a bit below trend. And interest rates really take a long time to cut in. We've had a year of falling interest rates, but interest rates need about a year and a half before they really bite. So the interest rate cuts we've just had will only really bite in the Australian economy in the middle of next year. So we've got about 2.7% growth on the Australian economy. So it's still growing below trend. The Australian economy is still in a growth recession. Unemployment's still drifting up. And we don't get out of this until the middle of next year when we get growth up to about trend. But the problem about that is even with growth at trend, unemployment will have gone up but not go down. We need to have a above trend growth rate in this country for a couple of years to get unemployment falling again. And maybe that'll be happening in 2014-15. Yeah. If the world economy, if the US economy picks up, which it probably will.
Yeah, but Michael, we've also got the dollar coming off the boil. That's going to help the local growth story, I presume. And also, we've got the issue of if we get a change of government and it inspires business to be more confident, could those two things make your 2.7% figure be slightly on the downside? Could it be slightly higher if business responds very positively to a new government, whoever it might be, and also the dollar maybe falls into the 90s and stays there?
Unfortunately, I think those who are expecting a sharp immediate fall in the Australian dollar may find that they're suffering from premature extrapolation. There are a lot of things holding up the Australian dollar. I ran our model this afternoon and fair value was about 102. Now that's lower than it was at the beginning of the year. The beginning of the year it was about 106. And we've had, of course, interest rate cuts. We've had a weak period in commodity prices. And there's a whole lot of other variables that we've got there which represent the US wholesale market and the flow of funds from the US wholesale market. But that gives us a fair value of about 102. That means the Aussie dollar can swing anywhere randomly between about 98 cents and about 105, maybe a touch higher, without it really meaning anything.
Right.
Yes, the Aussie dollar has built a broad top over the last couple of years. It's beginning to drift down, but it's not going to collapse anytime soon. In terms of the recovery of the Australian economy, well, like we are, as I say, in this situation of fiscal tightening, which whoever's going to get elected, we're going to be in a situation of fiscal tightening, and that puts downward pressure on growth. The other major source of growth that we can get from is further interest rate cuts done by, to be provided by the RBA. But they haven't done enough yet to really lift the Australian economy out of a growth recession. Maybe if they do more, it will. But I think we're going to be lifting out of this thing relatively slowly. And the external positive influence, well, yeah, if the US economy is better, we could come out of it faster. But we do need positive influence to lift the Australian economy out of this growth recession right now.
Okay, you can see I'm clutching for positive straws here, mate. What about Japan? Could Japan be a surprise story that helps the global economy? And it's still our second most important export customer. Could it actually give us a bit of a fillip that you're not currently seeing in your model?
Well, I think what is happening in Japan is more beneficial for Australian financial markets than the real economy. Again, if you look at what Olivier Blanchard's team have said about Japan, they are seeing quite a dramatic fiscal tightening over the next 4 years. Their budget deficit tightens from 10% of GDP to 5% of GDP. And so they've got significant fiscal tightening. They've launched this process of quantitative easing following what the Americans have done, precisely to counterbalance that fiscal tightening. Now, if you look at what the Fed is doing in the US, it's, according to Janet Yellen, who spoke about it, who's the deputy chair of the Fed, who spoke about it on April the 16th, what she said was that the reason that the Fed was buying long-term instruments, was doing quantitative easing, was to keep long-term interest rates low, was to bid up asset prices. And the purpose of bidding up asset prices was to generate stronger investment and stronger employment so they could get unemployment down. Now, I think the same process is happening in Japan. What you've got is a shift from demand from government demand, fiscal deficits, towards private demand caused by very low interest rates and quantitative easing. But it's a shift in demand in Japan. It doesn't necessarily mean faster growth, but it does mean that there will be additional Japanese demand for asset prices, so that adds to the US quantitative easing, and that supports our asset prices rather than our exports, Peter. That's the way it plays out as I look at it.
Okay, mate, fantastic. I've got to remember, I'll always remember you by premature extrapolation. It's a beauty.
Well, many economists suffer from it, Peter.
Okay, mate, fantastic. Now, usually budgets get me excited, but with an election only 4 months away and the government not really with the money to throw around after they've promised so much already with Gonski, NDIS and the WestConnex Road for Western Sydney voters, what else can these guys come up with? For me, the most interesting news is what Treasury is expecting for economic growth. Last year they tipped 3.25% and instead it's come in more like 2.5%, and this partly explains why there is no surplus right now. There was also some spending decisions by the government, the high dollar and the low commodity prices, but much of this could have been expected if Treasury was on song. Unfortunately, Treasury has had an absolute shocker in recent years, and this has not helped the Treasurer, but it would have helped if he and his government had done more to inspire business to invest. And that's how I'm going to assess tomorrow night's budget. Will the government right its wrongs, and will it get business confident? I guess if it does happen tomorrow night, or if it doesn't happen tomorrow night, sorry, we'll have to wait until September 14 and the election.